Nervous global investors are waiting to see whether the world's biggest economy has hit a speed bump or a brick wall. Financial markets were unnerved as US Federal Reserve Chief Bernanke acknowledged the loss of economic momentum without offering more stimulus. Australia may not share America's problems, but it still rattles consumers. And it's one reason an Australian retail industry report is pointing to the sector's worst performance in 20 years. Philip Lasker reports.
Global markets are on edge because the world's most influential central banker has delivered a stark assessment.
U.S. economic growth so far this year looks to be somewhat slower than expected. Aggregate output increased at only 1.8% annual rate in the first quarter, and supply chain disruptions associated with the earthquake and tsunami in Japan are hampering economic activity this quarter. A number of indicators also suggest some loss of momentum in the labour market in recent weeks.
Some analysts blame America's post-financial crisis strategy. They say mortgage debt and falling house prices are a ball and chain for American households, and the banks should have been forced to write off some mortgage debt in exchange for government assistance.
Corporations are sitting on over $1 trillion of cash. Banks have a lot of capital, but ultimately you need to sell what companies produce to someone, and that's the consumption that the households need to take on. But the households are underwater on their mortgages. Because they are underwater on their mortgages, there's a lack of mobility, which is usually the mobility in the labor market has been a big characteristic of the U.S. labor market, which is somewhat missing this time around.
Also missing this time around from Ben Bernanke was a promise to print even more money. Instead, there was a call to end the political bickering over America's debt.
If the nation is to have a healthy economic future, policymakers urgently need to put the federal government's finances on a sustainable trajectory. But on the other hand, a fiscal consolidation focused on the very near term could be self-defeating if it were to undercut a still fragile recovery.
A recovery which he maintained would gather strength.
With the effects of the Japanese disaster on manufacturing output likely to dissipate in coming months, and with some moderation in gasoline prices in prospect, growth seems likely to pick up somewhat in the second half of the year.
The debt and growth problems afflicting the US and Europe have been playing on the minds of consumers around the world. It's helped perpetuate the gloom, so Australian households with rising incomes are saving more.
That reasonable income growth has not translated to spending growth, and hence, probably the worst retail results in the past 20 years.
In its latest retail industry assessment, Deloitte Access Economics says retail sales will grow only 1.3% this financial year, but it's hoping the mining boom will see consumers spend more over the next 2 years.
Those things will be generating jobs and income and supporting the economy going forward. If consumers don't move further up the savings chain, that they keep their savings rate around where it is at the moment, that should be better news for retailers over the next year.
And some better news from this man will help as well.